I am of the view that this broadening out, this H.A.L.O rotation is very bullish, okay? That is my opinion. But it is also reasonable to talk about the other side. Well, market has lost leadership. Is it about to top? So I've got a bunch of charts to get through. Let's look at the top 50 stocks from Adam Parker. We're looking at the median gross margin by mega cap stock, X financials, X real estate. And yeah, guess what? A lot of the mega cap tech growth, wow, it's a mouthful, is getting sold because their margins are getting smushed. The market is not dumb. In fact, I would argue it's smart. Next chart, please. You love to see this. The S&P 500, the price is going up. The multiple is coming down. I'd say that's pretty healthy. Would you agree?
The price is going up, but well, is it healthy or is it concerning because why is the multiple coming down? When people
Fears. I like it. I like fear. Duality Research. Check out this no sniffer of a chart. Just last week, the S&P 500 recorded the most new 52-week highs since 2024 on a day that was likely the worst since Liberation Day for many investors. How's that?
Yeah, I mean it's
unreal.
It's just this like bifurcation, and people are just they're not worried about most of the stocks. They're worried about some stocks, and they happen to be worried about some of the biggest stocks, or were the biggest stocks.
It's hard to make the case that the market is peaking when you have so many stocks going up. I know that sounds like circular, but look at this next one from Duality. If you look back at how the S&P 500 peaked a year ago, both breadth measures were already rolling over. We're talking about the New York Stock Exchange Advanced Decline Line, as well as the number of stocks above their 200-day. That's in the green and the purple, and the gray backdrop is the S&P. So those breadth names were already rolling over. Right now, like literally, we're seeing the exact opposite.
I read the Adam Parker piece, and what he's saying is that the market is now pricing in lower margins. And the reason that matters is because the leadership stocks of the market had been the companies that were expanding margins. And now the markets are afraid that the biggest margin expanders are going to go through this multiple re-rate lower because, and you know, we're talking about Mag 7, like Amazon says we're going to spend $200 billion in CapEx. Like everyone's CapEx numbers are going up, which sounds great. And it is if you sell semiconductors, but it's unlikely that margins will survive. And I want to just share this one data point that I thought was, okay. The largest 10 companies are spending 35% of all the capital spending dollars of the top 2,000 U.S. companies. And that is clearly poised to massively rise given the guidance from the largest companies. And Adam says, this has to be a problem. We pointed out a couple of weeks ago, a legitimate bear case for U.S. equities is a lack of Goldilocks on hyperscaler capital spending, meaning too little and people get concerned that companies are worried about the return on investment. Too much CapEx and it results in an inevitable data center overbuild. So
I think that's a good take, but what if a company announces that they're going to spend not $200 billion in 2026? What if next quarter Amazon says, all right, we're going to pull it back to 160? You think the market freaks out? Maybe the market rallies on that and says, thank God.
You know what? It's a great question. But again, back to the gross margin story. He's saying gross margins of the mega caps are contributing to this overall gross margin degradation. Mm-hmm. And he points out median gross margins among the top 50 stocks have just fallen from 55.7% in December to 50.6% at the end of January. And that is the lowest level for gross margins since 2012. So these used to be asset-light companies with just insane gross margins. And now, given all the investments that they're making, and I'm not saying they're bad investments, and all the spending, and by the way, taking on a lot of debt too, et cetera, the gross margin story is degrading, starting with the biggest companies. And he's just pointing that out as a market headwind.
I would say that's a market headwind, a bear case for the mega cap stocks that are doing all the spending. Their bear case is the bull case for the 65% of the companies that are beneficiaries of all of this. So let's skip the next chart, John, and go to the breadth dashboard. So this is, we're looking at the stocks above their moving averages, various from 10 to 200 days by sector. We're looking at the ones that are making new highs by 4-week all the way out to 52-week, the ones that are making new lows, and we're looking at RSI. So this is a chart kit special. And the first thing that I want to look at is making new lows. All right. There's no staples, there's no energy, there's no materials.
Look at this.
What's making new lows in the short term, and there's really no 52-week lows to speak of. I mean, even within tech, which is, the epicenter, it's 5.7%. Communication services, 8.7%. They're making new 8-week lows, new 12-week lows. And yeah, they're falling below their moving averages. But look at the halos, the industrials, the staples, the energy. Like, look at the percentage of other moving average. They're all working.
Amazing.
They're all working.
They're all working, and barely any losers in those sectors. And if they are losers in those sectors, they're not noteworthy companies for the most part.
Okay.
Like, do you know UPS just hit my list of best stocks in the market? UPS. Remember what a basket case that stock was the last time we talked about it, which was probably sometime in the middle of last year? Because UPS is H.A.L.O. It's physical delivery of goods. There's no workaround. If you need to move things from point A to point B, you're using either UPS or one of their competitors, but people aren't up at night worried about somebody like stealing their thunder. And it's just a totally different market this year, and it's actually pretty exciting.
Okay. So is the market about to top? I've got two more for you. This is from Blue Kurdic. Pull this from Daily Chart Book. All right. The VIX closed above 21 after staying below it for 49 straight days. Historically, this setup has been bullish. In the prior 28 cases, the S&P 500 was negative only twice 12 months out, okay? Only 2 times out of the most recent 28 cases. We don't see those conditions today. This is a healthy market pullback.
Yeah,
I would agree with the data.
It's not what market pullback though.
Right.
Like what?
Well, there was a stock pullback. Now, the stocks have pulled back. Stocks have pulled back. Here's another one.
Right.
Here's another one from Turning Point Market Research. He's looking at the S&P 500 after more than 18% of its members registered a 52-week high, and it was at the highest level in over a year. And look at all those green arrows. There was one time it didn't work out. Right. So yeah, there's no guarantee, but this type of broadening is bullish AF. It just is. Doesn't mean it's going to work 100% of the time, but like that's what it is until it's not.
I think where it becomes problematic is obviously like whatever's working will always go too far. And then if all of these like quote unquote broadeners don't deliver on earnings or guidance, then it's like, well, what do we have to hang our hats on now?
Yeah, of course.
That's right.
Of course.
Because, no, but historically though, you had these 20% growers, mega cap software stocks with massive margins and unbelievably reliable cash flow streams from license revenue. And like the market could like fall back on those and they're gone. You don't have that layer in the market of like surefire stocks because they're no longer that.
Are taking the money out of those names and they're putting it into other names.
I just hope those other names don't disappoint.
So do I. Last one. I thought this was a really good chart. All right. Returns in 2025 versus so far in 2026. And what I notice here is the winners in 2025, it's really like almost all or nothing. They're either getting killed or they're ripping. There's really no in between. I guess Warner Bros., but that doesn't count. That's a special sitch. So on the one hand, the stocks that are under pressure that were major winners, AppLovin, Palantir, Robinhood. And the winners that won last year that are continuing, Micron, Seagate, Western Dig, Lam Research, Corning.
I wish I loved anything as much as you love saying Western Dig. I wish I did. I can't. Wait, put that back up. What else is on there? Teradyne. What's Fix? How come I don't know that stock?
Fix? That's
what
like
is that?
Stitch Fix.
No way.
It's on the S&P.
It can't be.
Fix stock. I don't know either.
Lam Research is on here.
Comfort Systems. I don't know what that is.
Comfort
Systems.
Systems.
HVAC. Oh, that's H.A.L.O.
Oh, that's
so
H.A.L.O.
H.A.L.O.
Are you kidding me?
So H.A.L.O.
That is like the definition of H.A.L.O.
All right, let's do Robinhood. So Robinhood is my favorite report to look at. Just visually, they do a phenomenal job. And Robinhood's got a good thing going. I mean, the stock was under pressure.
Not tonight, but
doesn't matter. It's a great business. It really is. They're killing it.
Yep.
Let's go through some charts.
All right. The first thing I want to say is just the reaction, and this could obviously change. This stock has fallen from 150 to where it closed tonight at 85, and in the post market is now down to 79.
Yeah.
This is a full 50% haircut if it opens at this price tomorrow.
It's crypto. It's trading off crypto. Period.
So somebody was saying like their crypto revenue percentage has fallen so much it's like less than 10% at this point. No, I don't think that's true.
That's not true. It
can't be true, right?
We have it here. Let's go through some charts. All right. Total platform assets, $324 billion. Is that, I mean, unbelievable. Yeah. Is that 68%? What does that say year over year? Whatever.
Put it this way. No one else in this industry has a growth rate that looks like this. Nobody.
No. All right. So here's some things that are not awesome. Next chart. The total net revenue was up 1% quarter over quarter. So, stalled out there. Operating expenses are growing, and I don't think the street like this. Operating expenses, the outlook was $2.6 to $2.75 billion, represents 18% year-over-year growth. That's high. The street did not like that.
Yeah.
All right, next chart.
Wait, but what's in that? What's in that? Like stock-based compensation, I get. What's in their operating expenses? That's like,
I'm guessing it's built out of prediction markets and investing in the business. I didn't have time to read into it yet.
I guess SG&A would, like, the advertising would be there. They're spending a ton of money on ads. That I know.
Check this out. Transaction-based revenue. So the options are just, I mean, unbelievable. Options up 41% year over year. It's where the most of their revenue, like by far, 3% quarter over quarter. But look at the crypto. So it's still massive.
Options is the neon yellow.
Is neon, yeah. So crypto is the light gray. So interestingly, it's down 38% year over year. It's down 18% quarter over quarter, but it's still a significant piece of the revenue. Yeah, 221 of 776.
I don't know who I was listening to. They were like, people don't understand, like, crypto is not as important as it used to be. I'm like, it's not.
Yes, it is.
I feel like it definitely is, right?
Look at the stock and look at Bitcoin. It's the same thing. All right, this is wild. Net interest revenues was up 39% to $411 million. And the thing that jumps out, obviously, to me anyway, is margin interest. $196 million for the quarter. People are trading their asses off and using leverage to do it.
Wait a minute.
Unbelievable.
They made $196 million in 90 days on margin interest?
Unreal,
Holy
right?
Shit.
I mean, this is stock aside, this is a good business. They are printing money.
They're loan sharking their users on margin.
They're giving people what they want. I love this chart. I love this chart. I love this chart. This is showing, okay, so on the one hand, yes, there is a not so small percentage of the user base that is having a good time, that is speculating. But this chart is showing the average cumulative net deposits, which has grown over time across their funded customer cohorts and recent cohorts. So the light yellow, okay, the 2021 cohort, you see that over time and how it's growing. But look more recently, look at the top line, the people that are putting money in today. These are legitimate deposits. Like people are growing up, they're aging, and I love it. I think this is a cool chart.
Now we still have this potential ABC pattern on the way down in gold. We just need to see gold come back down and actually break below the B point, validating that ABC pattern to the downside. Maybe gold just sits there and consolidates all along this area. Now, if you are looking to get short gold, I want to warn you guys, if we really start breaking above 5166.7, we could see gold come all the way back up towards the candle body right up here about 5409.9. And if we breach above that, we'll probably see gold run up and make another new all-time highs. Now, as we speak of gold and metals in general, prop firms have absolutely been getting destroyed. When we come over on X, I've seen Patrick trolling Michael Batak real quick, but look at this real quick. We already know that prop firms have limited metal trading for the time being, but look at this real quick. This is kind of funny. We will never have an intraday trailing drawdown, Top Step says. That was on June 18th, 2025. Well, it's kind of funny because if you look right here, now in their live accounts, well, they have a daily loss limit. Let me know in the comment section down below. Do you guys like this daily loss limit? Do you like this rule about the daily loss limit that Top Step is starting to implement? And if you don't, well, it might be a time to take a look at Lucid, where right now you can save 40% off all your valuation accounts. Use promo code Mike. And if you want to evaluate all the prop firms out there, go to Prop Firm Mike. Not only can you sort by prop firm, you can sort by challenge. Let's say you click on Lucid right there. We can scroll right down to the bottom. You can see the evaluation rules, hard breach rules, and funded rules in one simple location. So now as we come back over and we look at the SPY real quick, we see we got about halfway of that prior candle right in the middle of that body. Look at the MACD indicator, kind of flat line. Looks like it may be about trying to cross on the way back up. But I want to caution you guys real quick because tomorrow after the NFP data comes out, we already talked about what to expect if it's higher or lower. But let's look at the last three NFP numbers that came out. We look at November 2025, the ES, and this is the first 10 minutes, moved 109 ticks. The NASDAQ moved 400 ticks. We look at the NFP news in December. We can see that the ES dropped negative 25 ticks. The NASDAQ dropped 166 ticks. And in January 2026, the ES only went up 49 ticks and the NQ went up 267 ticks. So this is just a little reference point to what we could potentially expect for tomorrow. Now, when we look at the SPY, I want to look at this and look at the gamma exposure levels real quick. And notice we've been talking about that 700 strike price for quite a while. We cannot make it up there, at least not at this point. And every time we come up, they start fading the market back down. And once again, notice I'm starting to see a lot more red on the gamma exposure levels, and really 685 is sticking out to me. Well, if we look at the low out here today, we had a price point of 691.66. So does the NFP report come out tomorrow? Send stocks lower, getting down towards that 685 strike price, which would be right in the middle of this widespread candle. And if we're going to go down that low, if we violate more than 50% of that widespread candle, we're probably going to go all the way down towards the candle body, 681.53, and also target this distribution area within the composite profile. Now, when we come over and look at the 30-minute chart, look at the MACD indicator. The MACD indicator has a bearish cross, good separation of the lines, roughly a 45-degree angle on the way down. Also notice we closed the day near the low end of the session, and we closed below value area low. Anytime we close outside of value, I expect the next 1 to 2 sessions will come up and visit that level, but then look down below us. What do we have? We have a large gaping gap all the way down here at 677.43. Let me know in the comment section down below. Do you think we will fill this gap this week? Let me know in the comment section down below. Now we come over to look at the futures markets real quick. What do we have on the S&P 500? Well, we can see right here, we are already above the 786. Now we're starting to get back below it. And quite often when we start having price acceptance above the 78.6, quite often we do 100% retracement. Now, doesn't mean we don't fall back a little bit before ultimately going back up. And notice we've already been above the weekly value area high, and now we're currently below it. So if we stay below 69.77, I want to give the bears the benefit of the doubt that we're going to come down towards that point of control. Now, as we come over and look at the daily profiles on the 30-minute chart, all day long, chop, chop, chop. All we did was just chop around. And we had this untested point that we kept talking about today on the live stream. Now, if you guys don't want to miss the next time I go live, make sure you're subscribed and you have the bell notifications turned on for all. But just like with the SPY, notice what we did. We were able to close outside of value area low. So if we start getting back above it, watch the point of control. And if we break that level, I really want to turn my attention to about 69.82.75. In the event that we stay below value area low, one of the areas we talked about that even this morning on the live stream was this structure breakout point. We almost made it down there this afternoon, and that whole area is going to come in anywhere from 69.54 down here to about 69.48. Now, let's not forget, we are in earnings season. We have more earnings coming out. After the bell, we have Ford, we have Lyft, and before the bell today, we had Datadog come out, and Datadog was expected to move plus or minus 15%. Well, if we come over and look at Datadog, Datadog was up 13%, but let's look at it from the prior candle's close. Right up there, all the way up to the high. Notice it had a move of 17%. So check mark off. So that one hit what the expectations were. Now the question is, does it start coming back and potentially filling the gap? We've seen a lot of stocks after earnings actually not perform all that well. And we'll see if Datadog starts to follow suit as well. Now we come over and look at the Qs real quick. Qs today, notice we've only made it up to the 50% retracement, which could set up a much larger ABC pattern on the way down. Now I want to come over and look at the gamma exposure levels. Notice as I look at this chart, do we see more red protruding past the center line, or do we see more green? To me, the green looks very, very anemic. In the red, right around that 600 strike price, we have a lot of gamma exposure. Now, we come over real quick. Where is 600 at? 600 is pretty darn close towards the bottom of that widespread candle right over there. We breached that. We're probably going to go ahead and breach that low. And then that really opens the door to that ABC pattern on the way down. The price target on that will be 574.27. Notice I said if we break that level. If we don't break that level, this will not be a validated A to B equals C to D pattern. If we go up a little bit more, then we can still go ahead and drag that up here just a bit. But for the time being, I'm going to leave it where it is because it looks like we have the potential for a slight turn in this market. And notice today we closed below value area low, but just like the S&P 500, when we look left, we have that large gaping gap that was left behind from a few days back. That gap will be somewhere around 596.99. And the MACD indicator also has a bearish cross at this point in time. However, it doesn't mean we don't just simply fake down and start running back up. If tomorrow we're trading back above value area low, then I want to look for the market to potentially rotate back up through the profile, back up towards the highs of today, and then potentially start working its way up a little bit higher. Now, some of those higher prices could be right up here towards this high volume area, also the 61.8 level, right around 620 or so. However, with all the gamma exposure, I'm leaning more towards we're going to start working our way down towards where all that gamma exposure is to the downside. Now, we come over and look at the NASDAQ futures real quick. Notice what we're able to do. We were able to breach above last week's value area high, and now we're back down, which means we have the potential for a volume profile rotation on the way down.